Netflix results are out and shares are down about 12%. In this video, we're going to take a look at our earnings model and see if that 12% decline makes sense. So what we have up on the screen is the earnings model, including today's results and the latest guidance that management gave us in the shareholder letter today. Then on the left-hand side of the screen is the shareholder's letter. And then we also have the model that we had as it was stated prior to this release. Now, if you'd like to download our updated model, it's available for free on our website, gutenbergresearch.com. Click on the Models tab, and you can scroll down to the Netflix model, and then just click this icon to download it. We're also giving our users a conditional license to put their own estimates into the model and repost it to our website with a little blog or article too. So if you're interested, you can sign up to do that as well. So now let's take a look at the shareholders letter, and we're just going to go through the additional guidance that management gave us for the second quarter. So let's start with the US streaming business, which is this section here. We'll scroll down. So for the June quarter, management gave us guidance of 46.41 million paid subscribers. So you can see that we put that here by increasing the total number of subscribers by 1.5% quarter over quarter. So not a great growth rate. We had 5.3% growth last quarter, so this is like well below that growth rate. But the revenue per subscriber is a little bit higher than what we had in the first quarter of this year, and that's the number that's implied by the revenue estimate that management gave us. So they gave 1.21 billion in total revenue for US streaming, and you can see that in order to get to that, we had to increase our average revenue per subscription to 26.3. And that average might actually end up being a little bit conservative because we know that they're going to start to phase in those increases for the US streaming business, going from $7.99 to $9.99 for the regular HD content. So that 26.3 per average member might end up being a little bit low. Next, we can move on to the contribution margin for US streaming. So first, let's take a look at what we had in the model for contribution margin for this quarter. So we had 35.9%. That's what management's old guidance was. And it ended up being 35.5%. So the contribution margin was a little bit worse than what management had originally guided to for the last quarter. So now they're guiding to 33.2%. And you can see that's well below what we had in our model from earlier today. So as a result, we made the contribution margin for the June quarter meet that guidance. And then we also decreased our contribution margin and our gross margin for the US streaming business throughout 2017 to reflect that lower guidance, that lower result for the first quarter and lower guidance for the June. Next, we can move down to the international streaming business, and you can see that management had given guidance for last quarter of 31.8 million members, paid members. So they actually did a little bit better than that at 32 million. And revenue came in a little light, though, so it's a little bit less than what they were expecting on a per subscriber basis. The contribution margin or contribution loss was a little bit narrower than originally estimated. So the problem with the contribution margin for international business is it's up and down. It's so hard to predict. So we didn't make any adjustments in the future periods. We adjusted just the June quarter. So you can see we had originally had a loss of 13%, and we brought it down to management's guidance from this quarter of 10.6, and that's from this letter here. You can see international contribution margin of 10.6%. But there's just not enough transparency for us to comfortably adjust our future periods for the contribution margin in the international segment, so we left that as is. Then we can go back to the shareholders letter and see the other items that management gives us guidance on, and that is the operating income, 47 million. So we scroll back up to the income statement, and keep in mind that the marketing expense is reflected in the contribution margin for both the domestic and international streaming, and they're not actually spending on DVD. So that item is taken care of, but the technology and development and general and administrative expense, those two items are separate from the contribution margins of each segment. So we had to make some assumptions there, and you can see that we just basically tweaked those estimates as a percentage of revenue. So this is technology and development expense. So we have 9.8% of revenue versus 10.4% for the first quarter. And then G&A, we have it consistent with last quarter at 6.5%. And so when we make those adjustments, we actually got back to management's guidance of $47 million for operating income. Then for net income, we had to make some assumptions for interest expense, which you can see we held about constant with last quarter. And then other income has varied quite a bit, so that one's a little difficult to predict. So for the fourth quarter of last year, it was an expense of $3.7 million, and then last quarter it was other income of $26 million. So we have it set to 1.4, and we kept the tax rate consistent with the fourth quarter, and that's how we were able to get back to management's net income estimate of $9 million. And then on a GAAP basis, EPS is expected to be 2 cents for next quarter. So when we put all those assumptions into our model and take a look at the 2017 EPS on a non-GAAP basis, it goes to $1.29 per share. And you can see that in our consensus-based model from earlier today, we had EPS of $1.41 a share for December 2017. So that's what's driving our PE-based valuation from $108.50 to $99. And then the DCF, we didn't make any changes to our inputs, just updating the guidance and estimates for next quarter. And the resulting 50-50 based share valuation is $98 a share versus $105.25. So that's a decrease of about 7% or so. So not quite as steep as the 12% that we're seeing in after hours right now. But overall, we would say this is in line. And given the number of assumptions that you have to make to get to these estimates, it does make sense that shares are down, close to 10% or so. Be sure to check back in a few days. We'll update this model after the analysts have submitted their individual models, and we have a new consensus estimate, so we'll recalibrate it to meet that estimate. And if you're interested in financial modeling, please subscribe to our YouTube channel. Thanks for watching, and good luck with the rest of earnings season.